Pratik Agrawal joins us right now for his sense of what the mood is right now. Pratik, good to have you. I'm guessing that even you probably taken a bit by surprise, but how much further do you give to the market mood currently?
Well, this is a liquidity-driven rally. It is no two ways about it. So taking, that question has to be answered in terms of your call on where liquidity would go. And that's an extremely difficult call. The part which is going up is basically high beta. It's not quality. It's not supported by fundamentals, and that is where the challenge lies at this point in time. Given the fact that there are expectations that, you would have another round of LTRO maybe at the end of the month, chances of this rally sustaining at this point in time may be higher than the rally not sustaining. So it could just sustain. Maybe the index flattens out for some point in some period of time. Maybe it spreads out to stocks outside the index.
Right, but from the way things are right now, Pratik, does it seem more likely to take out 6,000 before budget?
If the numbers like what are being talked about happen in LTRO2, people are talking of 500 billion to a trillion euros at this point in time. Suppose it happens. Whether it is fundamentally driven, once again, we don't know, because any which ways you're getting a rally like the one we are having, and, if this is the kind of rally that goes on, where is the need for another LTRO? So that question nobody is asking at this point in time. But suppose the expectation comes out true, then obviously there will be more money sloshing around. Hardly any new issuance of paper. So, it's anybody's call. Market may move up. It's more demand than supply at this point in time. But clearly what one has to remember is that this is not driven by fundamentals, not supported by earnings numbers, and the quarter after would not provide support in terms of earnings. So clearly at this point in time, we believe market is moving ahead of fundamentals. We did analysis. We said 1340 Sensex EPS, and if you take a 15.5 times, you arrive at a number around 20,000 for the Sensex. From where we are, it's less than 10%, less than 9%, and the target is for the year. So, when somebody invests in an equity market, does one build in this kind of return expectation? It's actually less than what you get on some of the NCDs, which are significantly safer than equity market as a whole. So clearly it's not supported by fundamentals, but yeah, it can go higher because the surge in liquidity in the near term would be high.
Manishi Ray Chaudhary, who's the MD and Head of Research at BNP Paribas Securities, joins us on the show right now. Manishi, how would you characterize this rally, which has really surprised many on the street?
It is essentially liquidity driven, but so are most rallies. Over the last 1.5 months, we have seen about 4.5 billion in FII money. And even though domestic institutions have been sellers, this deluge of FII fund flow has clearly taken the market up. And in addition to that, there have been some better fundamental news flow as well. We have seen very clear indirect pronouncement from the Reserve Bank of India that rate cuts are around the corner, which was essentially the message in that 50 basis points CRR cut. And secondly, I think even policy momentum has revived, which is quite visible in what the government is trying to do in the power sector. So I think all this has added up to not just India moving in line with global and emerging market equity, but also outperforming them significantly. And this is, of course, coming in from a very low base, which the market had shrunk to at the end of last year, where valuations were appearing really attractive. And, it was a combination of attractive valuations on a low earnings base, which is always a good time to invest in equities. Having said that,
what about the way the broader markets have moved, the mid-cap and the small-cap indices, and the leadership really, or the move of the rally really started with those indices getting active. I mean, a 30% gain coming in for the mid-cap index, likewise for the small-cap index.
In fact, if you look at just the large-cap indices, let's say the Sensex or the Nifty, I think in nominal terms they have moved about 18 to 20%, and if you adjust for dollar, they have moved somewhere close to 28 to 30%, which is massive. In a span of 1.5 months, that kind of a move for a large market like India is huge. And some of the mid-cap stocks, which you just now alluded to, they have moved in the range of 80 to 100% during this period. So look at the second or third tier infrastructure companies, some of the public sector banks, which have possibly moved about 50% or so. But, honestly, we are not really advocating that institutional investors play these stocks. We are still advocating that investors look for quality and play the domestic cyclicals that have 2 or 3 characteristics. That is good corporate governance, corporate disclosure. Number 2, reasonably low leverage on the balance sheet, and good execution capabilities in their own sectors. So, for example, if you look at the engineering and construction names, obviously the top pick fitting these criteria should be L&T. If you look at the private banking space, it should possibly be a combination of, the top 3 banks like HDFC, ICICI Bank, and Axis Bank. Or in case of autos, it should perhaps be, Hero MotoCorp or Mahindra and Mahindra. So I think we're still advocating that investors stick to the top tier and play for quality and, the top-notch characteristics.
Okay. Manishi, and before we thank you for taking this time out specifically for joining us, is there anything that you would be circumspect on after this 20-25% kind of a rally that we've seen, in fact, more than that in certain large caps as well?
I think, the stocks that we just talked about, which have moved up about 80 to 100%, which are in the second and third tier infrastructure names. I think they're really offering an exit opportunity to the investor base, if an institutional investor is still holding on to some of them. Secondly, for some of the second and third tier public sector banks, I think this up move of close to 50 to 60% in some of them is offering an exit opportunity because the asset quality concerns are not yet behind us.